Welcome to the InterMarket Analysis video update. This video attempts to look at not only the S&P 500, but other stock indexes and other markets within the stock market, as well as outside of the stock market, to try to get some insight as to what's happening specifically with the S&P 500. This is being prepared for Monday, April 17th. The first thing that we look at is S&P 500 valuation. How is the stock market valued right now? Looking at this chart, this black line is above the red line, which means we're now expensive. This red line is a price-earnings ratio of 20. When we're at 20 or above, the market's considered to be expensive. If we were to drop down to this blue line, we would be at a price-earnings ratio of 15. At that level, the market is considered to be fairly valued. If we drop all the way down to the green line, that's a price-earnings ratio of 10, and we would be considered inexpensive at that time. Since we're above this red line, that's what I have down here below, showing how far above we are from that red dashed line. And anytime we're above this zero line, that means stocks are expensive. Now this chart looks backwards at the trailing 12 months, at earnings that have already come out. I'll show you in just a minute what the stock market uses, but this can still be a good gauge to give us an idea of what are the valuations of the market looking at different historical periods that have happened. Another thing that we look at is called the Shiller PE ratio. This is calculated a different way and takes an average over 10 years. Right now we have a Shiller PE ratio of 29.5. The median and the mean are between 16 and 17. So just looking at this chart the way it is, we are also considered to be overvalued. Now the market, as I said, looks forward, and we look at forward PE ratios as well. These are based on analysts' guesses and estimates, and these change all the time, and they're usually pretty rosy when they look forward. As of the 13th of April, the S&P 500 had a PE ratio looking forward of 18.3. So we're a little bit above 15, but we're still below 20. This is considered to be fairly valued on a forward-looking basis. Looking at the mid-caps, we have a current forward-looking PE ratio of 13.5. That's a little bit below the midpoint. And then looking at small caps, which have had some trouble lately, their forward-looking PE ratio is coming in right now at 13. And this changes every day as analysts adjust their outlooks and as these indexes go up and down. Another thing that we look at is growth versus value. This is a pure growth index showing that we continue to be in an overall downtrend. The blue line is below the red line. The blue line is a 50-period moving average. The red line is a 200-period moving average. We also look at a value index. This is still in an overall uptrend with the blue line above the red line, but we have been showing some weakness. However, over the last couple of weeks, value has been bouncing back. Now we compare the two. On top, we have growth versus value, showing that growth is underperforming. On the bottom, we have value versus growth, showing how value is outperforming. We look at some indexes comparing growth versus value, where we have been dropping down and growth has really been underperforming, but we are seeing some improvement. This next chart also shows value versus growth, showing how value has been in an uptrend, even though it's been showing some recent weakness. Here's another look using ETFs, showing how growth has been in a downtrend compared to value. This is looking at value compared to growth, where value is in an uptrend. And then the last chart, we look at a couple of different indexes, showing how growth has been underperforming, but it is trying to bounce back. We look at some inflation gauges. We have the CRB index, which are commodities. That's up on top, and this is a monthly chart where on the daily and weekly charts, we're in a downtrend. But what we look at here is the inflation to deflation ratio. When this is going up, that means it's more inflationary. When this is going down, that means it's more deflationary. This chart just shows that inflation has been decreasing as deflation has been increasing. We also look at the Baltic Dry Index. What does it cost to ship products from one place to another? We're still in an overall downtrend, although it has been spiking up a little bit recently. The CRB index measures commodities, and they're listed over here on the left-hand side. This continues to be in an overall downtrend, even though it has been coming back up to its 200-day moving average. Some other markets that we look at, here's the NYSE Advanced Decline Line. We're above this moving average, but we are declining. The S&P is also above its moving average, but declining. The mid-caps also above the moving average, but another concern are small caps, and we've been watching that. We're still below this moving average, and they're showing weakness on a relative basis. We also look at the biggest software companies, just giving us a recent golden cross and now starting to be in an uptrend. we're seeing tech really showing a lot of improvement. Then we look at different commodities. Here is corn and the current price. Aluminum has also been falling back down. Heating oil has been dropping. Gas is starting to go back up, and you probably see that at the pump. Natural gas, after getting quite high, has now been coming back down. Oil has been going back up after OPEC made their announcement that they're going to cut production. That means there's less oil on the market, so it becomes more precious, and they push the price up. We also keep an eye on diesel, which has been in a downtrend. Wheat has also been declining. We look at fertilizer, which has been coming down but is starting to turn back up. Lumber has also been in a long-term decline, but way over here on the right, it's starting to show some improvement. The dollar has also been in a downtrend. The euro has been in an uptrend when you compare it to the dollar. Here's a chart showing the Japanese yen on top, which is in an uptrend. The euro is also in an uptrend, where the dollar is now in a downtrend. Here's the British pound to the dollar, showing is outperforming the dollar. And here's a closer look at the Japanese yen to the dollar. Copper is still in an overall uptrend, but it's been treading sideways for some time now. The copper to gold ratio. Gold's been in the news a lot. People are starting to jump back into it. The copper ratio has been going down, meaning gold is outperforming copper, but we're seeing a little bit of a bounce back. And here's a longer term look at that same chart. We also put the 2-year yield on this chart. We tend to not get too far apart from each other, and in a good, healthy environment, they tend to go in the same direction. We're not seeing that right now. There's a real spread between the two, and they're not necessarily going in the same direction. Here's gold showing that it's in an uptrend, trying to break out, but then fell back down on Friday. Here's another newer chart. This is showing gold on the top and then silver on the bottom. And then at the very bottom of this chart, there's a correlation showing that gold to silver has a very high correlated relationship. They tend to go in the same direction at the same time. As I was looking over some charts, when we see the gold to silver ratio falling, that generally means that silver is outperforming. When we see the gold to silver ratio climbing, that typically means gold is outperforming. Well, right now, this ratio is declining, so that means silver is outperforming. Then we can also look down here and compare it to the dollar index. When the dollar index is going up, gold outperforms silver. And when the dollar index is going down, silver outperforms gold. So we're seeing this ratio where silver is outperforming since this is going down, and we're also in an overall decline with this ratio as well. So if you're looking at a pure play based on performance, you would probably look at silver based on this chart. But please also note that gold and silver can have the same trend. They can both be in either uptrends or downtrends. We're just measuring the performance. And then at the bottom, we show that there's a pretty high correlation between the gold and silver ratio compared to the US dollar. Here's a look at silver, where it's also in an overall uptrend, but it fell back on Friday. Looking at some different indexes, here's the CRB, which is now starting to underperform the S&P. This is the inverse, showing how the S&P is outperforming the CRB. This is looking at the S&P compared to the NASDAQ 100. The NASDAQ 100 has really been doing well, and we're seeing a recent golden cross with this ratio, meaning that the NASDAQ 100 is now outperforming the S&P 500. Looking at some other stocks, equal weight stocks are tending to underperform the regular S&P 500, which is a weighted index. The equal weight index treats every stock as the same. The mega cap growth, these are the really big companies. They're now in an overall uptrend. And then mega cap growth compared to the equal weight ratio, showing how the mega caps are coming back and showing some strength. The S&P 100 is starting to outperform the S&P 500. The S&P 100 are the biggest companies that make up the S&P 500. We're also seeing a recent golden cross with this ratio. And the small caps are really continuing to underperform, and we're seeing a death cross with this ratio. Volatility, which had been the place to be in 2022, well, we're starting to see a death cross with the ETF, and they're really underperforming the S&P 500, also a death cross in this ratio. The Dow Jones Composite Average continues to be positive. Looking at traditional Dow theory, where the Dow's been going up quite well, we're seeing a negative divergence with the transports. They're not going up with the Dow, and utilities had been doing okay, but now they're starting to roll over as well. We also have a new take on Dow theory, showing the S&P 500 on the top, where it's breaking above this blue trend line right here. Down on the bottom, instead of using transports, we look at the NASDAQ, where it's not breaking above this blue line yet. We're also watching this as a potential double top. If the Nasdaq can break above this previous high, not only in the short term, but going back into February, that would be quite positive for the market overall. If we continue to go down from here, that means that this is overhead resistance. The FANG stocks, which are Facebook, Apple, Amazon, Netflix, Google, and they've added some other ones and changed the acronym, but they continue to be in an overall uptrend when taken together. ARK continues to be in an overall downtrend, and it's been trading sideways. Then we look at the S&P 500 with other stocks outside of the US that are in Europe, Australia, Asia, and the Far East. We're starting to break below the moving average. That's a bit of a warning sign. And we have the PPO, which is one of our oscillators, continuing to show a decline. So this could be some negative developments that are coming into the S&P 500. So we want to keep an eye on this chart. Looking at bonds versus stocks, bonds tend to be in an overall uptrend when looking at the total bond ETF. World bonds are also in an overall uptrend. The stock-to-bond ratio shows that stocks continue to outperform bonds, but on a shorter-term basis, shorter-term bonds are still not outperforming stocks. The high-yield corporate bonds, we also know these as junk bonds, they continue to be in an uptrend. Investment-grade bonds are also in an uptrend. Looking at the stock-to-bond correlation, they're having a slight tendency to go in opposite directions of each other. Corporate bonds continue to be in an overall uptrend. Here's a look at the 10-year Treasury yield, and then we can see how the 10-year Treasury yield has been going back up over the last few days. This is another look at 10-year Treasuries coming back above its 200-day moving average. Here's the 30-year yield, which continues to advance. This chart also shows how the S&P is underperforming the rise in interest rates, showing a lot of improvement, but we haven't seen a golden cross with this ratio. Junk bonds continue to be in an overall uptrend, and when you compare junk bonds with government bonds, they are also outperforming, which is probably how it should be, since junk bonds are not only riskier, but they also bring in a higher yield. Looking at bond prices, we're starting to roll over with the MACD, and we've been dropping in the 7 to 10-year bond ETF. The RSI is still above 50, but it is declining. This is a daily chart showing Treasury yields, how they've been going up over the last few days. This is a weekly chart looking internationally with the US, UK, and Germany, showing how rates are going back up. Japan is its own little story that I'm keeping a close eye on, and if this really starts to develop into something, I will start talking about it in the videos. Some of the research that I was doing over the weekend looks at just the 5-year yield, and I got a lot of these ideas from Martin Pring, who is a very well-known technical analyst. This is the 5-year yield, how it has been going up, but lately the 5-year yield is starting to come back down. The special K, which is an indicator that he developed, is starting to go negative. And the shorter-term KST is also negative, but it could be getting ready to turn back up. So we want to keep an eye on this. We're getting some mixed signals. Also looking at the 5-year, and then we use the KST in the short, intermediate, and long term, showing that the yield is declining in the short term, intermediate term, as well as the long term. And that's why you're seeing a lot of people getting into bonds right now. They want to lock in a yield right now, with the fear that down the road the rates will be lower. Looking at the 10-year bond, dropping below the moving average but starting to come back up. Then we look at the financial sector and compare it to the bond ratio. The financial sector had been underperforming but is starting to show some improvement. And then the ratio shows that the financial sector is underperforming bonds. Then long-term bonds, still in an overall downtrend. Short-term looking better with the KST, intermediate term positive. Could be starting to turn up long term. Then we look at the 30-year bond price. That's not the yield, that's the price of the bond. And compared to the CRB index, this is starting to turn up and go more positive, which means that bonds based on price are now starting to outperform the CRB index. Then looking at the ratio between bonds and the CRB on a weekly chart, bonds had been really underperforming. But in the short term, they're starting to show some improvement as well as the intermediate term, but they haven't switched over positive yet. This is a new chart where I now have access to the MOVE index through stockcharts.com. I used to have to go out on the internet and do a screenshot. It only goes back a couple of years, but the MOVE index is the VIX for bonds, so it measures volatility. As bonds were going down, the MOVE index was really going up. As bonds are going up, this index really comes down. On the bottom, we have the VIX, and then you can also see at the very bottom, the correlation between the two is very strong. They tend to move in the same direction at the same time. If the MOVE index is going up and the VIX is going up, chances are stocks are going down and vice versa. Looking at the S&P in different sectors, this is a concern. In a good solid environment, the S&P would be really outperforming utilities, and in fact this ratio is declining. The staples sector is still positive overall. These are things that you have to have no matter what's going on in the economy. Then looking at energy, which was really strong in 2022, we're getting ready to see a death cross in this ratio when you compare it to the S&P 500. The tech sector is in an overall uptrend. Semiconductors are in an uptrend. The tech sector is outperforming the S&P 500. This is a look at discretionary where it's underperforming the S&P 500, but it has shown some improvement and has had a strong 2023 so far, but it kind of comes and goes as far as showing some consistent performance. Then looking at the energy sector, it's still in an overall uptrend. It could be getting ready to have a death cross in this ratio. The materials are still in an uptrend, but showing some weakness. Financials, because of the banking thing that's going on, we've now seen a death cross, even though financials are bouncing back slightly. Real estate continues to be in a downtrend compared to the S&P. Utilities are also in a downtrend. Healthcare, also in a downtrend. And here's another look at healthcare. We saw a recent death cross in the ratio between healthcare and the S&P 500. Communication is in an overall uptrend, and we saw a recent golden cross in this ratio. Staples, recent death cross. Industrials, still in an overall uptrend compared to the S&P. The NASDAQ is starting to outperform the S&P 500, and we saw a recent golden cross with this ratio. The NASDAQ 100 is outperforming the NASDAQ. Some other areas, growth, which are growth stocks compared to bonds. Growth is now resuming a much more convicted upward trend when you compare it to bonds. But bonds are also showing some improvement. The energy sector is starting to underperform the tech sector. And here's another look where the tech sector had been underperforming the rise in interest rates. We're starting to see that change with a golden cross in this ratio. This is an inverse showing how interest rates were really going up, and now we're seeing a death cross. The rise in interest rates are no longer outperforming the tech sector. Discretionary continues to underperform staples, but it is showing some improvement. Staples continues to be in an overall uptrend. We got really close to a death cross here, but so far staples has picked back up. Gold is outperforming the S&P 500, and gold is also outperforming the dollar. High leverage loans. If we were going to get ready to fall off a cliff, this would not be going up the way it is. These are risky loans, and they're in a pretty solid uptrend. Looking at the InterMarket Analysis chart going back to the beginning of 2022, oil is in first place, followed by gold now. Third place is the dollar, where we look at stocks and bonds. They are still negative. Just a quick look at banks. We compare the regional banking ETF to the financial sector. And the regional ETF is really underperforming as we're working our way through this banking crisis. Also, we keep an eye on the different yield curves. The 10 to the 2 and the 10 to the 3 month are probably the most important. Those are below this red line. That means they're inverted. The 30 to the 5 year is above the red line. That's our only yield curve that's somewhat normal. And the 10 to the 5 is still inverted. The bottom one I don't use all that much because the Fed funds rate is only updated about once a month. This looks at cash compared to the tech sector. When this is going down, that means the tech sector was really doing well. People wanted to get in tech stocks instead of keeping their money in cash. The beginning of 2022, all of that reversed, and now we're seeing it start to switch back as tech is gaining more favor. Looking at some indexes, the micro cap index, which are the really small stocks, we're seeing a death cross here, but they have not made a new 52-week low at least yet, but they did so very recently. The small caps have been really underperforming and have a lot of overhead resistance above current prices. Here's the Russell 2000 small caps, where we're seeing the RSI still above 50 but declining. The MACD continues to go up, but the small caps continue to be below both their 50 and 200-day moving averages. The small cap ratio to the S&P, that's the red line, shows how small caps are really underperforming. And looking at the Elder Impulse system, they are negative. Then looking at the mid caps, having some overhead resistance at this pivot level, but we are above the 200-day moving average, and the Elder Impulse system is neutral. The Dow is above both moving averages and hitting some overhead resistance at this R1 level. The diamonds, which is the ETF based on the Dow Jones, is currently at neutral. The Nasdaq is performing better with a recent golden cross, but we have some significant overhead resistance. Can we break through that, or are we going to fall back down from this level? The Nasdaq 100 did break out, but also has some overhead resistance at some of these previous pivot levels. Can we break through and make a new high, or are we going to fall back down? The Qs for the Elder Impulse system are now at neutral. And here's a Fibonacci look at the Nasdaq 100. We were able to get above this 38.2% retracement level at 12,864. If we fall down, that may act as support. The longer we can stay above that, the more that support level may hold. Are we going to break and go higher from here, or are we eventually going to fall down below that? We'll want to keep a close eye on this. Looking at the NYSE composite, also in an overall uptrend. The Wilshire is in an uptrend, which is another broad-based measure. Then we look at the Amex, the Nasdaq, and the NYSE. We take a 5-period moving average of their highs minus the lows. This is a warning sign. We remain below zero. In a good solid environment, this would break above zero, and it's not doing that. All stocks, though, however, are remaining in an uptrend. Emerging markets are also in an uptrend. Looking internationally, we're seeing pretty much solid uptrends across the board when you use the KST to measure those trends. Bitcoin has been able to get back above 30,000, and we have seen a recent golden cross. This is showing how money is starting to flow back into Bitcoin. Then we look at some correlations. This is the S&P to the dollar, pretty much a neutral relationship, slight tendency to go in opposite directions. S&P to oil, also in the neutral area. S&P to the 10-year, showing that yields and the stocks are tending to go in the same overall direction. The tech sector to the 10-year correlation is in neutral territory. And looking at the 2-year, we're seeing stocks and the 2-year yield having a fairly strong relationship going in the same direction. Then looking at the home builders, we saw a real negative divergence down here, but the market has rebounded since then. So we'll be keeping an eye on this. As the S&P's been going up, the home builders has been going up, and the ratio is not really all that strong down here. In a good solid environment, we want to see this ratio going up, and it's actually been declining. So we will watch this. Looking at our long-term secular trends, this is a monthly chart of the NYSE. We're still above this moving average. And down below, the Copic curve is starting to turn back up. So this is a broader measure that is turning more positive. This is also the NYSE composite, and we're seeing this NYSE record high percent index continuing to go up. That is also positive. Looking at the S&P 500, the PPO on the monthly chart is turning back positive. Then we're showing how the S&P 500 is finally starting to outperform the CRB index. The S&P continues to outperform global stocks. We're above this moving average, but look at the KST. It's starting to roll over negative, so we want to keep an eye on that. The price of bonds continues to be in an overall downtrend, but they are outperforming the CRB index. An update of a couple of our possible positive scenario charts. These are the S&P 500 stocks above their 50-period moving average. As we've been going up lately, this measurement has also been going up. The mid caps also showing some improvement, and then the small caps are showing a little bit of improvement. But if I go back to the beginning chart, see how the large caps are doing the best, followed by the mid caps, and then the small caps are in third place. In a good solid environment, we want to see them move more in tandem with each other. So what is positive? This is measured by the 50-period moving average being above the 200-period moving average. We have value, which still remains positive. The big software companies, the euro, the Japanese yen, and the British pound, copper, gold and silver, mega caps, the Dow Jones Composite Average, the FANG Index, bonds, whether we're looking at the different kinds, whether they're ETFs, government bonds, corporate bonds, world bonds, junk bonds, they are all positive. Staples continue to be positive. Tech and semiconductors, high leverage loans, small caps, mid caps, and the Dow, the NASDAQ and NASDAQ 100, the NYSE Composite, as well as the Wilshire, all stocks, emerging markets, and then on the bottom is Bitcoin. These are things where the 50-period moving average is below the 200-day moving average. Growth continues to be negative. The CRB is negative. The dollar is negative. This is the new one. The low volatility ETF has given us a recent death cross. Micro caps are also a new addition. Is that going to feed over into the small caps, which will eventually feed over into the mid caps and large caps? We're just watching for that. And ARK also continues to be in a downtrend. Thank you. I hope you found this helpful. Please feel free to check out the daily video, the weekly video. After this, I will be preparing what I call the deep dive video, where I go over the charts that I really didn't talk about this week, but sometimes we can still get some useful insight from them. I hope you're having a wonderful weekend, and I will talk to you in the next video.